Welcome and good afternoon to everyone. This is the 16th webinar since we started this series back in March when we first went into lockdown. Whilst we continue to face the virus, we will continue to offer free webinars, and we're very pleased with the number of people that have been able to join us today and with previous webinars. Next week, as part of our anti-money laundering webinar series, we will be holding a free webinar to assist firms in understanding simplified and enhanced client due diligence and also politically exposed persons. Today, though, we're very pleased to be covering the new world of third-party managed accounts, which I'm convinced will become very popular in the very near future. We've got two very good presenters today. I'm very pleased to introduce Darren and Geoff. So Darren has over 20 years experience within legal finance, working both in practice and within the legal IT industry. Darren is currently the Director of Education and Development at the Institute of Legal and Financial Management, where he's responsible for managing the education and development for the Institute, including training and qualifications to ensure the consistently high standards of the Institute. Geoff Dunnett is Professional Services Director for ShieldPay. He is a qualified solicitor and has practiced as a project finance lawyer at Millbank, Tweed, Hadley and McCloy and Mayor Brown, before working as an independent legal consultant. Geoff's transactional law experience has helped form the functionality of ShieldPay's third-party managed account and corporate escrow offering. So I'm just going to stop sharing my screen, and I'm very pleased to hand over to Darren.
Just confirm, David, that you can see the PowerPoint?
Yes, indeed, I can.
That's brilliant. Technology is working then. Off to a great start. So good afternoon. Hello to the faceless audience. You just love doing these when you can't see you guys the other side. I thought I'd start off firstly by touching on what a third-party managed account actually is. Apologies if I'm teaching any of you here to suck eggs, but I think it's massively imperative that we're all clear at the outset as to what one actually is. Now, from the regulator's perspective, the SRA define a TPMA as an account where a third party, so a payment service provider such as ShieldPay, holds money on behalf of two or more transacting parties. Now, for law firms, that means a third party would hold funds for you and also for your client. It's worth mentioning here, there was nothing in the old SRA Accounts Rules 2011 that ever prevented you from using a third-party managed account. However, in the 2019 rendition, the SRA has made it a little more obvious that they can be used under what is now Rule 11. So first and foremost, it is not a client account in accordance with the SRA Accounts Rules 2019. The money held in the account is client money, but does not fall under the definition of client money in the Accounts Rules. And the reason for that is it's not received or held by you. It's received and held by the third-party managed account provider. So in effect, the rules do not apply to money held in the TPMA, save for Rule 11, which I'll come on to in a couple of slides' time. So why use the TPMA? Why not stick to the good old-fashioned general client account? What are the advantages? Well, I'm going to be brutally honest here. TPMAs will be right for some firms and not others. It's very much dependent on you as a business and how you as a firm think you can best manage the risks related to holding client money. I'm not going to lie, there are some associated costs by using a TPMA. They're not free, shock horror. That said, by using one may reduce your overall firm's overheads, especially if you're only occasionally holding client money. For example, using a TPMA to hold client money could reduce your professional indemnity insurance or your firm's contribution to the compensation fund. There would also be no longer a need to have an accountant's report prepared, the AR1. Don't forget, when using a TPMA, you will not be operating a client account or holding client money so far as the accounts rules are concerned. As I said in the previous slide, the money held in the TPMA will not fall into the definition of client money. Therefore, a substantive part of the accounts rules will not apply. Another potential cost saving could be in respect of your, whilst I think about it, your practice management systems. If you hold client money in a client account, you're also bound by Rule 8 of the accounts rules, in that all receipts and payments which are client money must be recorded to the client side of the client's ledger. What are the implications of this? Well, this forces your firm into purchasing and using expensive, bespoke, specialised accounting systems to meet those requirements. So operating a TPMA will enable you to use much cheaper off-the-shelf applications. There are other potential benefits beyond cost savings. As we all know, it would be nigh on impossible to completely eliminate all risks relating to cybercrime. But the use of a TPMA could be a more secure way of handling client money. Using a TPMA may also help address your firm's money laundering risk, as the TPMA provider will be responsible for undertaking AML due diligence as part of being FCA regulated. They're the ones handling the funds, and so responsible for ensuring that all necessary checks have been undertaken. Now, a firm may choose to place reliance on the due diligence undertaken by the TPMA provider or undertake their own. It's entirely up to each firm. So let's summarise. Reduced risk. Now that's got to be a good thing, right? Nobody enjoys managing risk, or do they? Reduced costs. It's got to be appealing. Certainly in the current climate, with the likes of professional indemnity insurance skyrocketing through the roof, or dropping client instructions, and firms struggling with cash flow as a result of COVID-19. One of the fundamentals of managing cash flow is the conservation of cash. So you reduce your costs, you save on cash. It's a no-brainer. Cast your minds back to the global financial crisis of 2008. Those firms that acted swiftly to cut costs were the ones that came out the other side in the best shape. And I can tell you from conversations I've had with members of the Institute, we're seeing exactly the same at the moment. The majority of the SRA Accounts Rule 2019 do not apply. Again, surely this is appealing. So on the face of it, in theory, you'd have less breaches, as you'd no longer need to worry about transferring costs promptly, returning money to the client promptly, dealing with residual balances promptly. Or do you? What does Rule 11 say? Rule 11 is clear in that you take reasonable steps to make sure that the client is informed of and understands their rights and obligations and what the use of a third-party managed account means in their particular case, including whether they are required to authorised payments and any charges or fees they are liable to pay. Transparency is key here. It's also clear under Rule 11 that you must obtain regular bank statements and ensure that these are checked and that they reflect the transactions on the account correctly. You must also make sure that the funds in the third-party managed account are only used for their designated purpose. Lastly, you maintain an overview of the transactions on the account and keep the appropriate records to reflect this. I'm hoping Geoff from ShieldPay will talk through the logistics of this during his session. So the SRA will expect all firms and individuals regulated by them to comply with their standards and regulations when using a TPMA. Don't forget, using a TPMA, and I can't stress this enough, does not absolve your obligation under Principle 7 to act within the best interests of the client or to take steps to safeguard clients' money or assets entrusted to you in accordance with 4.2 of the Code of Conduct for Solicitors and 5.2 of the Code of Conduct for Firms. Make sure, and again I want to stress this point as well, you are not assisting with anything unlawful when using a third-party managed account. To put funds into a TPMA in an attempt to hide money would not be lawful, i.e. assisting the client, for example, with tax evasion. You will need to carry out an assessment of the suitability of the TPMA in the particular circumstances for a particular client. You need to ensure that the client understands the basis on which the money is held and that it is different to regular client accounts, i.e. that the regulatory protections that apply to TPMAs are different to those that apply to client money held in the firm's client account. Again, we need to be clear and transparent. You also need to ensure that the client is aware of their right to terminate the agreement, their right to dispute payment requests made by you, and that they understand exactly who is responsible for the costs associated with the agreement. Now, if you decide a third-party managed account is the right thing for your firm, what steps and checks should you take? Well, first and foremost, before you engage with the provider, you need to ensure that the provider is FCA regulated. Also, that it's an authorised payment institution or equivalent. So, for example, a small payment institution which has adopted voluntary safeguarding arrangements to the same level as an authorised payment institution, or a European Economic Area authorised payment institution. The TPMA must be an account held at a bank or building society operated as an escrow payment service, and the monies in the TPMA must be owned beneficially by the third party. So in terms of the SRA and what they need to know, first and foremost, you do not need their permission. Good news, do not need their permission to use a third-party managed account, but you must notify them that you intend to use one. And you do that by completing a form via the SRA's website. And they will want to know things like the name of the provider's FCA authorization number, and the date you intend to start using the third-party managed account. Now, if you're using one third-party managed account provider for multiple clients, you only need to notify the SRA once. If you're using more than one TPMA provider, you must notify the SRA of all providers. You must also have suitable systems and procedures in place. Paragraph 2.1 of the SRA Code of Conduct for Firms requires you to have in place effective governance structures, arrangements, systems and controls to ensure your business and employees comply with the SRA's regulatory arrangements. You must therefore have suitable arrangements in place for the use and monitoring of TPMAs in accordance with the regulatory arrangements. This includes having appropriate internal systems for monitoring the transactions on the accounts and keeping appropriate records. And on that note, I'll hand you over to Geoff from ShieldPay, who will talk through the logistics of how they actually work.
Well, thank you, Darren. Thank you, everyone, and apologies for my late arrival. There was a technical mix-up, but I'm here now, and I can take over for the rest of the session. Incredibly useful outline of the rules and procedures involved of third-party managed accounts. And in my presentation, I'll give you a brief introduction on ShieldPay, but then also actually give you a little demo of what it actually looks like in practice and go through the contractual arrangements that we have in place with our current crop of clients. So, ShieldPay is an FCA-regulated institution. We are probably the only third-party managed account provider in the UK at the moment, but we also can call ourselves the leading one too. We developed our solution directly in line with the SRA's rules and changes, and so have been closely working with the SRA and the CLC in the development of the understanding and guidance surrounding third-party managed accounts. We received Innovate UK grant funding, which was supported by a number of the regulators, the Land Registry, as well as Barclays Bank and a number of prominent conveyancing law firms that helped develop our conveyancing offering. And we currently partner with over 70 lenders and law firms to provide payment services to them. And we received a few awards along the way, which is always nice for the morale. But why are people moving to TPMAs? And I think Darren did a great job at explaining some of those elements, but I thought it's important, and the regulation and the rules around it, but I thought worth spending a few moments around some of these sort of underlying societal or shifts in approach that are forming this. So there's client money, and firms are moving away from that because there are 104 or so reports of misuse of client money every month to the SRA. Nearly 80% of law firms have had one phishing attack of some sort to their account, to them. And over £11 million has been stolen from solicitors' account over 18 months. And these numbers are often different depending on the sources you get, but this was in a report for the 16 to 17 year, 18 months, 11 million was stolen. So the regulatory and operational risk outweighs the benefit of the interest that you can get over funds in client accounts, and this particularly in light of potential negative interest rates that we might see. Fingers crossed that doesn't happen, but that is on the horizon. Firms are looking to reduce risk, drive efficiencies, and adopt new technologies to provide better customer experience. And this is one of the ways that around the handling of funds, this can be done. The increased threat of cyber criminals is on everyone's radar now. And so as people are working remotely from home and etc. in these terrible COVID times, that threat continues to increase. The cost of professional indemnity insurance, as many of you will be aware, is increasing, particularly if you are a conveyancer, and the difficulty of either getting or even securing, or at least having a reasonable insurance policy is getting quite difficult. The ever-changing requirements from a money laundering and customer due diligence can be for the larger firms in the country much easier to handle because there are specialist teams around that. But if you are having to run your practice at the same time as keeping up to date with those ever-changing rules and regulations, it can be quite costly and burdensome. And now under Rule 11, there are And as Darren rightly pointed out, it's never been prohibited, but it's now very much enshrined into the rules of the SRA, into the new accounts rules, that it is permitted to explore alternatives. And again, it's not for everyone. It's not going to be for every law firm. For some firms, and we can talk about that in a little bit more detail in a second. But in short, there are two different models that at least we've approached at ShieldPay in terms of a third-party managed account. And that is where a firm chooses to outsource their client account function fully, and so no longer run a client account. We have firms that do so in their whole entirety, and some firms that only use us for specific transactions, or that and have an arrangement there, or that are for standalone transactions where they effectively refer their clients to us directly and aren't even involved. So I thought it was worth kind of going through each of those from a contractual arrangement point of view. So there's with the TPMA provider and the law firm, there's an underlying commercial arrangement that will set out the costs for the service and the relationship and how that is developed. There are underlying framework payment services terms that will dictate and based on payment services regulation, how the TPMA provider provides its services to the law firm's clients fundamentally. And in the way that ShieldPay is set up with their clients, or with our clients, is that the law firm is effectively mandated by the clients to authorize payments on their behalf. That is dictated around the engagement letter, plus an annex to that engagement letter that sets out the details that Darren explained in his presentation around what needs to be clearly explained to the client around costs, disputes, termination rights, and so on, and contesting payment rights. And they also, within that, agree to subscribe to our terms and conditions too, which is the next part of the triangle. And in that construct, we have firms that do property transactions, conveyancing. So we are now have conveyancing firms that are on most major UK panels. We do loan distributions for Oak North Bank. We've done fundraising for equity fundraising and debt fundraising, mergers and acquisitions, fees on account for barristers' chambers, as well as for normal high street law firms, claims management on PI insurance. We've done probate matters, we've done litigation, settlement, personal injury, family law, and project accounts around construction projects and real estate. So a wide variety of use cases in this particular model. And here, importantly, is that we are the client only of one of the parties to a transaction and not all parties to the transaction. In the other option, which is the transaction-specific one, which is where we are, in effect, there is an arrangement with everyone in the transaction, and everyone enters into a specific agreement or contract with the provider, and may, depending on the provider's terms and conditions, may either be standalone or link back to some more generic or general terms and conditions in the way that we have done it at ShieldPay. And here, the firms on either side might be a party to the agreement, as well as the clients, and could also have other stakeholders involved in the transaction too. So particularly around construction projects or development projects, where you may have a project monitor or a chartered costs surveyor being part of the release mechanics for those funds. And here we have a wide variety again, but corporate escrow has been a mainstay of ours. So for various different reasons: mergers and acquisitions, litigation settlement, retention amounts, dilapidation funds, and again, project accounts. So I thought, and hopefully this will work, I've tried it before, but I thought I'd give you a very quick three-minute video of what it looks like and what the process is. And so there's explanations on this there, and I'll let the video run, and hopefully that will give you a good flavor of what the platform can do. So the ShieldPay platform is effectively considered like a bank account meets a case management system or data room. we're setting up a matter. Take the type reference, which could be your matter reference, the fee earner's email, whoever's most responsible for it, the expected total amount of the transaction, the currency in which you're going to be expecting to do it, the date that it starts, the estimated end date, and then the number of digital approvers that will be required in order to facilitate any payments. Then at the sort of the shell of the project is created, or the matter. You set the permissions, and so who can authorize those payments. And here the fee earner in question is the one that's able to authorize the payments. And then we invest investors to the account. So these people have been created on the platform, invite the new user to the platform, and they're sent an email to go through an onboarding process with a one-time PIN and complete our onboarding process and source of funds checks and etc. Until we as part of that process. They're sending funds. And you can apply this to any number of scenarios, as you'll see, and the numbers can be whatever you want them to be, high or low. Reviewing the information and continue. And here and then, you view everyone who you want to has access to this. So you can, the investors in this particular scenario, fee earners, accounts teams, compliance, whoever in your firm that you want, you get real-time notifications as and when funds land, as do the stakeholders. And then when you're ready and the conditions have been met for the release, you authorize the selection. In this case, there's only one authorizer, but you could have up to 3 authorizers that could be both internal to the firm as well as external to the firm, being the conditions of the release of those funds. And then you get provided a status of what happens. And we provide at the end of that a statement of account on a regular basis, as Darren said, is required to add to the file of the law firm at any given moment. Generally speaking, our clients, it varies massively, but it'll either be, it's generally driven by the accounts team. So rather than them logging into the bank account details, they use the ShieldPay platform to run all of that element. So it's the ledger and the account in a way. Oh, of course that would happen. Oh yeah, sorry. Some of the benefits of using a system like this, there's a mitigator of a number of the risks of breaches of Rule 3. Improve customer service and transparency over an element that has always been non-transparent. No statutory compensation fund contributions. No ongoing compliance requirements to SRA rules, as money being held is not considered client money. There's no client account audit costs, I mean, or most of it at least, as Darren covered, but that also covers internal management time of dealing with this. It removes unbillable tasks, and including allowing accounts staff and to be focusing on value generation work rather than some of the slightly more mundane elements of the work, and being able to focus on what really is important. Chits are replaced, transparency is there, so people aren't required to provide reporting or lengthy reporting in that way. Not having to deal with residual balances, I think is probably going to be welcome to most of you who are on this call. And will be seen as good risk management in the eyes of PI insurers. Whether that equates to a reduction, that is yet to be fully determined, but it will in any event, it's a risk mitigant, and so will be seen favourably. I was asked to give a bit of an idea of what the costs would be. So here is sort of our baseline model. On the TPMA side, it's a monthly management fee that starts at £500 a month. And that depends on the number of transactions you do, the number of users that you have, and the size of those transactions and the complexity of these. We provide merchant card payment services and include all KYC and AML as part of that. And as Darren said very usefully about the placing reliance or not over the checks that we do, that is something that that is will be an interesting topic for years to come, I'm sure. On the corporate escrow paying agent side of things, which is transaction specific, it ranges between 0.25 and 1.5% of the funds held, but that again is these are sort of indicative costs, but these are all subject to enterprise type relationships that we develop with our clients. So who has been using this so far? So we've been very fortunate in recent years to have a very wide group of clients, not just law firms, but also lenders and of all sorts, shapes and sizes. And so, you know, you are in good company of those considering these things. Some of the larger firms, top 50 firms, as well as some much smaller boutique law firms and conveyancing practices and lenders of different types have been using our services over this time and continue to grow. So I think I'll stop there and see if there are any questions from the audiences. I'm sure that there probably will be, or even Darren or David may well have some for me directly.
Well, I was just going to say, Geoff, it would be good if we just answer any questions that we've got that have come in. If anybody does want to ask any questions, now's the time to use the Q&A facility. We've got a couple of questions come in, and this first question, I don't know if either of you have this, but there's a question there in the chat that says, do you produce a summary for clients of the benefits and differences between a third-party managed account and a client account?
We provide the, I guess, the documentation that we provide as our sales material to law firms to provide as they wish to their clients. We also provide a precedent annex. So we provide some suggested wording that law firms can use to demonstrate this to their law firms. In short, yes, we do, but it's not exactly sort of a benefit analysis for the client ultimately. Because generally speaking, it's been that law firms have, and although the clients are obviously entitled not to accept to use a client TPMA, absolutely, but in the firms that we have been working with to date have either said, well, this is the way that we work, and you can choose to either engage us on that basis because we use a TPMA provider, or not, rather than give them sort of a choice.
Okay, thank you. I wouldn't expect Darren to have done that. I'm sure ILFM would not have done that. I guess that's correct, isn't it, Darren?
It's correct, yeah.
Yeah. Okay, fine. Well, on to the next question. There's a question which we do get from time to time: is can we have a certificate of attendance, etc. And in all honesty, we stopped doing this in 2016 when the SRA abolished CPD. And it's a matter of self-record nowadays about your training records. But if you really feel that you would like some confirmation from us, please feel free to send an email to us. That would be info@dglegal.co.uk, and we can confirm that you did indeed attend this webinar. Okay, next question. If we are dealing with a firm using a TPMA, how do we verify the account details, e.g. using Lawyer Checker? Either of you like to go with that one?
Yeah, very happy to. So we have an arrangement with Lawyer Checker. So we lodge against the law firms that or confirm to Lawyer Checker the account details associated to that law firm who uses us. That's only on request by the law firm as part of our engagement with them, and we've done that for those that you do conveyancing, because that is where Lawyer Checker is mostly used.
And there's a follow-up question from the same person saying, if we are dealing with a firm using a TPMA, are we at risk if the TPMA hasn't been set up properly and funds are lost?
You're at no greater risk than you would be if the firm was holding those funds, because those funds are held in safeguarded client monies accounts and have to be set up properly every single time.
Okay, thank you, Geoff. Another question here for you is, And I think I know the answer to this one, but it's really for you, Geoff. Does Shield Pay do the client due diligence, and if so, how?
Yeah, so we do client due diligence to the extent that it's in relation to the funds, right? So we will do source of funds checks, we will do ID verification, we will do PEPs and sanctions and adverse media checks on individuals, on businesses. We will go up to ultimate beneficial owners of those businesses as part of our KYB checks. What we do not do is we don't do the other aspects of what CDD is whether or not the person is actually the owner of the assets that they're trying to sell, or that they are entitled to have the authorizations to represent the company in any way, or the entity that they're doing, or any of the elements that are, are fundamentally we consider the lawyer's prerogative to be deciding. But we will do that level of customer due diligence.
Okay, another one here. I'm conscious that some people are asking questions in the chat, but I'm going to focus on the Q&A and then maybe move to the chat. And if I mean, we're already running a little over, I'm going to carry on just for 2 or 3 more minutes. And any questions that we don't answer in the next 2 or 3 minutes, we will answer afterwards, and we'll send you a copy of the Q&As along with a copy of the slides and indeed a recording of the webinar. So the next question, there's quite a few that have just come in. The question is, so ultimately the investor pays the commission and fees, question mark. So I think if I reword that, I think what the question really is, can you pass on these costs to the client?
I can answer that, Darren, if you, or so the way that we have said it, and this actually been an interesting one for Darren, for your view on this, Darren, but we've always told firms that the fees incurred for the transactions are effectively legal fees or can be disbursements, and so can be charged directly to the client.
Well, that's really interesting, isn't it? Because if you think about the cost of operating a client account, they don't get passed on to the client. So it's a key difference there. Darren, do you have any thoughts on this?
Yeah, immediately. Obviously, it's a bank charge that what we're talking about here is effectively passing on to the client. So from an SRA's perspective, you would need to be clear in your terms of engagement that these charges, these are fees and not something you've paid on behalf of the client and that you'd be potentially charging the client for. From a VAT perspective, that then becomes subject to standard rated VAT when you pass that back on to the client.
Well, that's an incredibly good question, isn't it? Because it just shows a huge difference there between treatment of these fees and treatments of client accounts, etc. Let's just maybe take one. Well, there's only 2 questions left here, I think. Do you check source of funds or source of wealth? And that's Geoff.
Yes, so we do, as part of our due diligence, we have to do that. So fundamentally, as Darren did point out in his presentation very well, was that the TPMA provider is ultimately the one holding the funds and the one who is potentially doing the criminal activity of handling stolen money or incorrect funds. So yes, we do, and so that is part of our checks. And we, as for every regulated entity, whether SRA regulated or FCA regulated, it is a risk outcomes approach. So it's based on the risk profile of that particular transaction, the level of checks that we do.
Okay, final question then, and this is a really good question, Geoff. I've asked this question to you in the past on behalf of one of our clients. Really good question. Is money held in a third-party managed account directly accessible to participating firms, or are all payments have to go through the managers of the TPMA?
So in the way that ShieldPay is set up, and this may well be different with other providers that are existing or coming to the market, but the funds are not directly accessible by the law firms. They have to effectively create a payment slip on the ShieldPay platform to make those payments out, and each of those lines of payments need to be evidenced in some respect. So there has to be a reason for each of those payments. And so it's not directly accessible, and it goes through the authorization requirements that we set out in that video.
And just one comment, Geoff, before we finish. One of my other clients' potential objections, which turned out not to be true, was that there was a belief that they had to wait 30 days until they got access to the money. And you said, no, it could be same day.
Yeah, so we turn around transactions same day. There is, you know, the important point is around the authorization of the client and the ability for them to dispute a payment, and the way that we or payment request is that by asking for the active authorization by a client for the release of those funds, that's granted that they've authorized that transaction, and so you no longer have that issue of possible delay.
Okay, great. Well, listen, thank you very much, Geoff and Darren. I think you've been superb, and I think it's a really interesting topic. I've got no doubt that this is going to take off. It's going to become really, really popular, and I'm looking forward to some of our clients working with you, Geoff, in the future. So congratulations on a very good product. Now, we will send you, as I said earlier, a copy of the slides, a copy of the recording, and the Q&A will write up. If you would like to get in touch with us with any suggestions for future webinars, we would very much welcome you doing so. So please send any such email to info@dglegal.co.uk. We will send you in a few moments' time an email asking you to rate the webinar. Be very, very pleased if you wouldn't mind just spending a couple of seconds clicking on an appropriate rating, reflecting whether you found this webinar to be useful. And just a reminder that our next webinar is a week's time, and it's the latest in our series of AML webinars. So thank you very much for your participation, and I look forward to seeing many of you again next week. Thank you and goodbye.
Thank you, everyone. Thank you for your time.
Thank you.
Cheers.